Okay, good morning, everyone. I think we'll slowly make a start. We'll continue to admit people that are slightly late joining. But good morning, everyone. Hope everyone is well. By way of quick introduction, for those of you that don't know me, I'm Joe Ratcliffe. I'm a global customer claims exec, part of the UK claims relationship management team. Thank you all for joining this latest webinar in our country and region in focus series, where we will provide a detailed overview of the local claims environment, regulatory framework, roles and responsibilities for both insurer and policyholder, along with some practical guidance on process and procedure across a region of focus or a country of focus. We'll also pick out some key and unique elements of some local case studies. Today, we're really pleased to be focusing on India and delighted to be joined by Anuradha, who is our claims specialist within our network service centre, Bahrain, and also by both Ramraj and Ashish from our trusted partner in India, HDFC Ergo. And they will all be leading us through the presentation today. So a big thanks again to Anuradha, to Ramraj and to Ashish. Pleased also that we're being joined by a number of our key customers from the UK, key brokers and partners as well, and also by members of the Zurich UK and international claims community also. So just a big thank you again for all of you making the time and effort to join today. It's much appreciated. I think Anuradha, if you're happy to move to the next slide. And again, on just to the next slide, just to quickly cover off a few housekeeping aspects before I pass to Anuradha. You will have seen that you've all been set to cameras and microphones off. That's just to avoid the potential for any background noise, but questions are absolutely encouraged. So please feel free to submit those either via the comments function or via the Q&A function. We've got an hour and 15 minutes, so hopefully there will be an opportunity for us to tackle some of those questions. If we do run out of time, then we will commit to address those any remaining questions as part of the information which we'll share following the presentation today. And that will also include a copy of the slides and access to the recording as well. So with that taken care of, I will now pass over firstly to Anuradha.
Thank you, everyone. Good morning and welcome to this webinar. So my name is Anuradha and I'm part of the Network Service Center in Bahrain. The Network Service Center in Bahrain, we handle the countries which is shown in the map here. Majorly the Indian subcontinent, the Middle East and North Africa is the key countries we handle out of the Network Service Center here. The Indian subcontinent, India, Sri Lanka, Bangladesh, Nepal, Bhutan, Pakistan, Afghanistan, and Maldives. In the Middle East sector, we handle Bahrain, Saudi Arabia, UAE, Qatar, Oman, Kuwait, Iraq, Yemen, Jordan, Lebanon, and Egypt. And in the North African area, we handle Morocco, Mauritania, Tunisia, Algeria, Djibouti, and Cyprus. Cyprus, of course, is an additional country that we handle. So these are the countries that we are handling through the Network Service Center, where Zurich does not have a local office. So we manage these countries through our partners there. The main responsibilities of the NSC claim handlers, just to give you an overview, is coordination with Zurich PCs and local network partners in the respective countries. Facilitating the claim handling standard claims with the local network partners. We maintain and update the claims data in the ZIPU portal, which is Zurich International Program Universe, and IPS. We also manage the data quality in case of wherever missing data or missing information are there. We manage to collect this from the local partner and update it in the system. We also participate in regular discussions with our partners, the local network partners in all these countries which we have mentioned, to facilitate client servicing locally in terms of claim. So the key areas where we are not involved is direct claim handling under the local policy. Because these claims are handled by the local partners, the policy is issued locally. So the claim handling is generally done only locally. So it's directly handled by them, and we don't normally regularly get involved in the day-to-day activities. However, coverage decisions like any declinations are referred to Zurich by the local insurers, the local partners, and we take it up with the Zurich producing countries to confirm declinations so that it can be checked whether there is any claim, there is any coverage under the master policy. Okay. And there is no local contact with the brokers or the customers unless there is any special requirement or any special case where our involvement is required. Otherwise, all the handling of the local broker and the customer is done by the local insurer. So that's just a brief overview of our role in NSE Bahrain. With that, I'll hand it over back to Joe. Joe, I think you will need to give access to HDFC. I think they are having some issues with the sound and the video.
No, we've got it. Thanks, brother. Vishal.
Hi, namaste. This is from India. My name is Vishal Sekan. I head the commercial business at HDFC Ergo, which is one of the largest private sector players in India. We are amongst the top three insurers in the private sector player. Today, we're going to kind of spend some time as Zurich partner and talk about liability claims and underwriting parts of it. So thank you, Zurich, for giving us this opportunity. I'm joined with a strong team of my claims and underwriting team members in the commercial line of business. And possibly they're going to take forward this presentation. So I just wanted to thank you for giving us this opportunity and being out here. Just to give you a quick view into what HDFC Ergo is all about. We are a joint venture between HDFC Limited, HDFC Bank, which is one of the biggest financial conglomerate in India, and Munich Re's primary insurance arm, Ergo. So that's the joint venture. We've been in the business for the last 22 years. When you look at our scale today, we are the second largest retail health underwriter, a very strong network of channel partners, and also a humongous customer base, active policies. We've been very successful in the M&As that we've taken place in the country. So we acquired two companies to become inorganically even larger. When you look at the growth rate, something that we feel very proud of, we've recorded a 2x growth rate as compared to the industry over the last 14 years. Our market shares currently stands at about 6.4%. We are a very strong player across all segments of business, whether it is motor, health, or commercial underwriting, including the crop insurance piece. Overall, we have secured 5+% in terms of market share across all our product segments. I'm also happy to report that we are a very strong player in the commercial segment, and right from refineries to employee benefit, we currently underwrite everything out here. We have a very strong partnership with Zurich, and very happy to report that we service a good number of clients in India through HDFC Ergo. Yeah. So with this prelude to our presentation, I'd like to kind of hand it over to my colleagues who can take you through with the other slides.
So I think from HDFC, we have Harini, the liability claims head, who will be taking it forward.
Right. Yes, good afternoon, everyone, or good evening, whichever time zone you're in. Thank you very much for giving us the opportunity to present to you over the next 1.5 hours an overview of liability claims in India. But again, it's a very specific focus area for us. We're going to look at the litigation and the third party, particularly from a litigation perspective, nitty-gritties of liability claims. I think I'm also joined by two of my colleagues, Ashish, who represents liability underwriting, and Ramraj, who specifically looks after also liability claims. I lead a couple of claims underwriting and product functions in the company. So, I think what I want to do is set the context to some of the topics we will discuss before we move on to the next few slides. I think, broadly, if you look at the liability landscape in the country, it's split between casualty and financial lines products. Today we will look at very specifically from a litigation perspective, case studies related to certain products like workmen's compensation, CGL. But other than this, we've got a lot of exposures in crime, cyber, DNO, EPLI, PI, particularly tech PI, product liability cover. So what we will do now over the next 1.5 hours is sort of look at scenarios which lead to potential disputes in the country. And here we will cover scenarios which look at mergers and acquisitions, employment related from a workman's compensation or a EPLI related product. We will also look at things from a deficiency in goods or services provided, which is more from a consumer perspective that land up in consumer courts, also commercial disputes, and these are very particular in, say, professional indemnity products. So we'll go through scenarios of that nature as well. Technology, media, telecom, IPR infringement is another topic we'll go through. I'm just giving you a background on certain scenarios we'll cover, which then will lead into certain case studies across multiple products that we will cover. But before we do that, Ashish, would you want to give a background on from an underwriting perspective on how we approach liability? Then we can move into claims.
So yeah, so as Harini rightly said, the liability lines are classified into casualty and the specialty lines. The casualty lines are basically taking care of your third-party bodily injury and property damage covers, and your financial lines or the specialty lines are taking care of the financial loss resulting from a negligence in a decision making. That results into cover for damages and the defense cost which a third party incurs. So that is basically the crux of a liability policy. Yeah.
So let's move on to the next few slides. I think before we look at liability policies and the nitty-gritties of scenarios which will lead to potential claims, let's first understand what the current, I would say, legal structure in the country is. We'll start with that and move forward.
Hi, good morning, everyone. Ramraj here. I'm handling liability claims, HDFC ERGO, of course, partner with Zurich in India. So before taking ahead to the cases which we have dealt till now and with the liability lines, just want to give you a brief about how this Indian courts work, what's the hierarchy, as you are seeing in your jurisdiction also. More or less, it remains same. But since India follow a common law, as it's in UK, so on the same line, it is the apex court. We have Supreme Court, and below that, there's a two line of court. First is National Consumer Dispute Redressal Forum. It is NCDRF, which is the appellate authority of State Consumer Forum and the District Consumer Forum. And then there is a High Court, which is again a constitutional body, which is the appellate authority of many civil courts, which is situated at every state, in fact in every district. Criminal court, it is again available in each district of India. Revenue court, it's available at each tehsil. Tribunal is specifically work-specific tribunal, just like SEBI, that is Security Exchange Board of India, then Company Law Tribunal, DRT, then specialized quasi-judicial body. So these are the bodies which are specifically being formed to readdress a particular point of law. So even for our liability purpose, we can see that for companies dispute, so there is a specific tribunal to that effect. There is a company law tribunal which decide the dispute between the companies or the functioning of the company. And similarly, there another line of disputes which moves into a high court is the arbitration. So it is another form to settle the dispute. That's the arbitration and conciliation, which has been acknowledged worldwide. So in India also, the arbitrations, any order passed by the arbitral court is subject to review by the High Court. And this is the structure of Indian courts, how it functions. So this is it for the consumer and the High Court forum. It consists of criminal and civil disputes both. And with a new regulation which steps in, so we will see recently that the commercial disputes in India, that is being the pecuniary jurisdiction has been increased. Earlier it was 50 lakhs, now it is being increased to 1 CR. So any commercial dispute having a value more than 1 CR, it is for those purpose. There is a specific code called as commercial code in India. So yeah, and for the next slide, so these are the regulatory bodies which basically regulate the function of any corporate in India. So to precisely, SEBI basically govern the securities, shares debenture, and the issuance of IPOs and all those stuff that has been regulated by SEBI. RBI again regulate the your funds which is coming from outside India to India to fund any organization. So all the financial activities are being monitored by RBI. So FEMA and AML guidelines are being regulated by RBI. Then there's a Ministry of Corporate Affairs which basically monitor the functioning of a company which is registered in India. So how they are functioning, whether properly board has been formed or not, whether the compliance of the Companies Act has been properly done or not. So these are the regulatory bodies which is established in India to monitor the functioning of India. And similarly, apart from regulatory bodies, there are investigation agencies. So to bifurcate the investigation agency, there are two type of agencies. First, which come under the state matter, and another which is of the union matter, which we call it as a central agency. So for state agency, they are these central investigation authorities and the police authorities, which basically deals into the investigation part of any wrongdoing. It could be employee related, or it could be any injury to the third party. So for that purpose, this police authority steps in. For CBI, Enforcement Directorate, then DG of Competition Commission of India, it more or less evolve into the investigation of a company or an institution. So this is the investigation framework within India. So to complete an investigation, normally in India it takes almost 90 days to 6 months to complete an investigation, and then it file their finding to appropriate authority for proper adjudications.
Yeah, I can start the next one.
Yeah, Anurag, please. Yeah. Next slide.
Yeah. So I think this is where we will start looking at a few scenarios or from a transaction perspective that can lead to potential disputes, and mergers and acquisition is probably an interesting aspect to look at. If you were to look at mergers and acquisitions as a topic, a lot of disputes and M&A. Particularly that we have seen in India is largely dealt with issues relating to failure of disclosure of relevant information, maybe misrepresentation, breaches of certain reps and warranties. In a lot of cases, shareholder-related disputes as well, and disputes over valuations. But a lot of them tend to occur, post closure of a deal. And I think the perspective with which we are trying to cover here is what could be the implication from a liability insurance perspective if you were to offer a cover like this from, say, a rep and warranty perspective. So what you typically see in mergers and acquisition are complexities around the way funds come into the deal. It could be a buyer and a seller based in India. The funds inflow is fairly straightforward here. What if there is a buyer in India, a seller from another jurisdiction? How would the funds flow happen in such a complex environment? Securities transfer, and obviously tax implication of such deals is some of the aspects that could lead to potential disputes. And as Ramraj clearly explained in the earlier slide, a lot of these transactions come under the scanner of SEBI, RBI, and they oversee funds movement in most of the mergers and acquisition deals. In India, obviously, the process for M&A in a code-driven case can be fairly long, drawn out, and the Companies Act consolidates all these provisions, and the central government also plays a pivotal role in sort of going through a lot of these transactions. So mergers and acquisition is a good way to start looking at some of these complexities when it moves into disputes. I think just also alluding to what Ramraj said earlier, security transfer from a funds perspective also involves SEBI, Ministry of Corporate Affairs, NCLT, high courts. I also mentioned about disputes that can potentially happen from a shareholder perspective. And I mean, 2 years is fairly an outer limit. We've seen transactions which have taken a longer time as well, depending on the industry where the transaction happens. And maybe you want to talk about some of the litigation cases that might arise out of M&A transactions.
So that has been kept at later stage. So yeah, so the litigation which we see, I mean, which arise out of this merger and acquisition is basically coming out of the fund mismanagement. The fund has been utilized for a different purpose for what it was intended to. And there was a layering of fund for which it has been used. And then, of course, there are regulatory bodies and investigation agencies which are doing investigation against the directors and the officers of the company, which again put a potential risk to those insured person to incur a substantial amount. And similarly, there are chances of SEBI inquiry onto the whole transaction, this M&A transaction. So these are the potential risks involved in such kind of transactions, for which our liability policies steps into picture to cater the need or to cater the address of such cases.
Yeah, we can move on to the second scenario.
Yeah, the next one is the employee related matters. So I mean the companies. So as in other jurisdictions in India also there are several litigation which is going on due to employment practices. So we have a dedicated code for that purpose. There is dedicated legislation to ensure that employees' benefits are not curtailed, they are being properly paid, and there are laws in place to ensure that the weaker section of societies are being properly placed. To take it ahead, I mean, there are regulatory bodies, there are authorities who make a proper check onto it, and which has resulted or which has casted responsibility on to the corporates to ensure that they are compliant with the labor laws of that country. So such kind of transaction where you're dealing with the employee can result into a litigation wherein the employee is claiming or alleging certain kind of allegation against the employers, which can be of breach of contract, could be the case of compensations, or there are cases wherein criminal proceedings has been initiated by the employees against the employer. And for India, there is a posh case also. There is a prevention of sexual harassment cases. So there is a separate guideline to address such kind of cases. So we have seen that cases are arising out of this employment relationship against the corporate and to the directors of the companies, which will result into a potential loss or potential risk. Next slide, please, Another. Then for deficiency in goods and services, so yeah, companies and the organization involved into manufacturing and also to provide services, be it IT company or be it a manufacturing hub. So for India, since it is the fastest growing economy right now, and we are producing as many services and the products, and also we are outsourcing it, and we are exporting it to the different countries and within India also, which gives a potential risk where the goods for the purpose intended to does not fulfill that purpose, and or it may lead to injury to the third party. And for that purpose, that there's a provision in India called as Consumer Complaint or Consumer Court, Consumer Protection Act, which helps customers to file case against the corporate or against the parties who is providing these goods and services and to seek compensation. Apart from that, there are regulatory bodies law like FSSAI, the Ministry of Corporate Affairs, which take care of what is the goods which is being manufactured, are they safe for the public use or not. And if it is not safe, then there is a inquiry and there is a provision of penalty to those corporate. Similarly, there are chances of corporate dispute when the two business houses involved into contract for providing services, right? If that doesn't go well, then there are dispute among those business houses, and then it lead to a commercial dispute. So as I said earlier, that the pecuniary jurisdiction of commercial disputes for commercial court has been raised from 50 lakhs to 1 crore. So such kind of dispute against goes to the commercial court for redressal. And yes, this again leads to a potential risk for Indian entity to face. The next.
I think one example here is also when you look at India being a hub of manufacturing, it's a fairly I would say the value chain and supply of goods within the value chain is a very pertinent point, because that is when your commercial disputes between two commercial entities become even more pertinent, and that is where we've also been seeing some sort of raise in disputes leading to these getting into commercial courts. And I think another point is also the fact that some of these can also get colored as criminal cases. So cases of forgery, I would say, protracted invoice payments or forgery of potential invoices. So all these also get covered under the deficiency of services as one of the scenarios leading to disputes.
Next. Another aspect of Indian jurisdiction is that we are seeing cases coming out of the technology, media, and telecom usage. So it is more related with IPR infringement when we talk about the media and telecom. It's like intellectual property rights infringement cases. So for in India, it is the High Court which basically adjudicate this IPR infringement cases. So in India, as such, there is no data privacy law. Currently, there is a Data Protection Act which has been passed, but rules is yet to be framed. So we will address that in next slide. But to be very specific on this technology, media, and telecom, here there are the disputes which can arise on account of infringement of intellectual property rights. So there could be a false and misleading claim related with the advertisement which has been done by the corporates or any other entity. So on the regulatory aspect, there are regulators who basically oversee the functioning or any kind of advertisement which is done by the business house, whether they are compliant with the law or not. So there could be a potential risk to the individual who is employed in the company, for which the regulator can take actions. And we have seen in past, generally for intellectual property dispute, it takes 3 to 5 years to get resolved.
I think, one important point here, and the most important point for all of us to sort of look at, is the data protection law in the event of handling individual data threat cases. So I think all of us in some way or the other work in an industry which looks at handling significant amount of personally identifiable data, and which is where Ramraj made a reference to the Digital Personal Data Protection Act, which is the DPDP Act, which is framed in the year 2023, which we'll walk through a little later, as a way where the regulator and the government is looking at processing of digital personal data. How do you process it? How do you store them? What could be the rights of individuals to protect, and what could be the consequence and the liability on companies if there is an event where the data goes into a public domain through a leak and their identity gets compromised. So I think that becomes a very pertinent point given the digital world we operate in and the significant amount of PII data that most corporates in the country handle, which is something that we will sort of dive in and understand a little deeper in the coming slides.
Next, please. So this transition named as capital market and taxation. So basically, when the corporate is raised fund through equity or debt from from private funding or through a public market. So in such kind of matters, so the transaction which an entity does is that sourcing of fund, maybe from Indian market or from international market through JV or private equity. Then how they issue the shares, how they dispose it off, what kind of compliance they are doing, if they are compliant or not, then tax implication into it, then GST and income tax, corporate tax. So these are the key element whenever an entity indulge into a capital market transaction, then they are required to oversee all these functions. So as I said earlier, that these transactions are basically regulated by SEBI and RBI. The transaction which is completed, it has been properly required to be notified to the Ministry of Corporate Affairs also. If such kind of fund has been raised and the shares has been issued and the capital structure of a company has been changed. So such kind of transaction basically lead to certain kind of disputes, which is mentioned as SEBI inquiry. If some kind of inquiry has been formed and it is identified that the directors are negligent or some kind of default has been done by them, then of course SEBI leads some kind of penalty to those directors. Then there is the inquiry of RBI, then Minister of Corporate Affairs on the AML guidelines. Then there are the chances when the investor or the creditors of the company are filing a criminal complaint or filing a proceeding before NCLT against the corporates. So these are the probable risks which comes out of these transactions. Another next slide, please. So, yeah, insolvency and bankruptcy code. Any insolvency proceedings are in India is taken care by National Company Law Tribunal. So it is like that if an entity is going for restructuring or insolvency has been declared or bankruptcy has been done, so the creditor of that company can file a complaint before Company Law Tribunal to have a specific order from that. So in such cases, so it is a very general risk which an entity is currently facing. So any financial creditor can file an applications before the NCLT in order to have an insolvency order against that entity. So basically, what a timeline as per Act says that it should take place within 180 days of the admission of an application, and such application should be decided within 330 days. So this is what Act says, but normally in India we have seen that this case get prolonged for another 2-3 years before it get adjusted. Then national is Indian competition law. There is antitrust law. As you are aware, in US we call it as antitrust law. In India it is Indian competition law. So it is ensured. I mean, this law is basically aims to ensure fair competition practices in market. So we have seen that when the merger has happening or some kind of if some company is gaining some kind of substantial share in the market, which reduce the competition, and at that point of time, we have seen that DG, that is Director General of CCI, has stepped into the picture and started the investigation. So recently there is a cement cartel which has been outbursten by the DG by having such kind of investigation. So it is basically to eliminate the anti-competitive practices, and this furthers the potential risk of litigation against the DNO of the company. Next one, please. Yeah. So this is the Digital Personal Data Protection Act, which is passed in 2023, notified on 11th August 23. So basically, as in the line of GDPR of Europe, on the same line, India has passed its own Data Protection Act. It is basically aimed to safeguard the personal data of individual, which is of important nature. The idea to pass this act was to ensure that the PI data of an individual is safeguarded, and the entity who has the fiduciary relationship to ensure that these data are preserved or kept in a safe manner should be held liable in case some kind of negligence is found during the investigation. So the key feature of this act was that it has empowered the Data Protection Board to investigate such kind of breach. It has given the power of civil court, and the penalty for any kind of default can go up to 250 crores. in case of personal use. So this is the key feature. So currently, the act has been notified. So act says that rule will be followed later on. So currently, rules has not yet notified. Therefore, this act does not get full implementation currently. So as soon as this rule will get implemented, this act will come into the picture with full flow.
I think relevance for liability insurance here is very pertinent from a cyber insurance perspective, where a lot of cyber covers, apart from first party, looks at third party loss as well. And this already sets a benchmark threshold of limits that companies should ideally be buying in case they handle PII data. Also critical from a PI perspective, because PI also in a way covers sort of potential third party losses. If you have a cyber-induced PI transactional leak of personal identifiable data, there's a potential impact from both perspectives, and which is why I think this act particularly is very critical for corporates to consider, how well they would like themselves to be protected for potential exposures, which can be levied upon them as fines and penalties.
So on the casualty lines, when we say that the litigation for compensation, so we are seeing that compensation for bodily injuries and property damage arise out of these acts which I have mentioned. So there are proper statute where an aggrieved party can claim compensation by the usage of motor vehicle, by the use of Electricity Act. There are Employee Compensation Act, wherein the compensation or the injury arise out of employment can be claimed from. Then Federal Accident Act, Public Liability Act. So these are the acts which I mentioned over there. And there would be certain cases where the person has sustained the injury, but in absence of any specific act, there is always a law of tort or law of equity for which a person can claim compensation before the civil court. So there is a provision in India to address such kind of issue also. So on this claim experience, what we have seen in last 2-3 years on account of product. So on verbal combustion policy, we have seen that a normal time to settle a case is almost 1 year, with an average payout of 800,000 rupees. So this is the average claim size which we have shown here, depicts the claim which we have seen in last 2-3 years. For CGL also, there is a product liability for which we have seen that the normal claim size goes around 400,000 rupees. And average time to settle such cases are 2 to 3 years. For crime, it is 2.5 million INR. For cyber, it is 10 to 15 million INR. And average time is within 1 to 2 years, this case gets settled. For DNO policy, we have seen that the average payout is 1.5 million INR, and with an average time of 3 to 5 years. Since it goes into the litigation decided by the court, that's why the average time is 3 to 5 years.
That's sort of an overview of what we're experiencing in the current portfolio. I think let's just look at some of the extremes, right? So one example is cyber, where that's got probably the highest average claim size or payout, because the severity is quite high. But if you can see the tail, it's fairly short compared to a PI or a DNO cover. And also largely because in India, there's a significant first party loss which is offered, and probably a lot of the third party losses have not yet been tested. So within a first party loss, immediately after a cyber incident happening, what gets covered are your ransomware cost or your forensic investigations, where the way you can size up and quantify some of those investigations tend to be far more quicker. So 1 to 2 years justifies those, but obviously with the impact of DPDP Act, and when you start looking at more and more third-party costs coming in and more such scenarios going into courts of law, then that timeline can increase, but so will the severity increase. So that's just one example to keep in mind. The same for crime as well. I think crime, another angle, Ramraj, we might want to talk about is also this aspect of investigation from the police authorities, and say the filing of the FIRs to how the proceedings and the investigations happen, which are very linked to the way we also assess coverage positions under crime policies, where 2 to 3 years is a lot when it goes also into litigation, but also is linked with the investigation capabilities of the competent authority. I think workmen's compensation, while it's 1 year, it's fairly straightforward because it's driven by the Workmen Compensation Act, and what the Act largely prescribes in terms of either compensation or what you can pay for an injury, right? These are all fairly standard medical costs that are assessed. So I mean, while the average stat is one, in a lot of cases we've also been able to streamline and try and bring a lot more efficiency to pay those claims. But as long as it's not in the litigation ambit, I just want to give some examples of some extremes that you observe here, and how also the scenario for, say, cyber and PI is changing pretty rapidly in the country. PI, particularly when you look at tech PI, a lot of Indian companies provide services to a lot of companies abroad. So while the TAT of 2 to 4 years might be related to Indian jurisdiction, we also need to be mindful that when Indian companies provide services to companies abroad, a lot of the third-party losses that might come might also be driven by those local jurisdictions. There could be class action that can potentially get covered under PI policy. So the complexity is also just wanted to give you some example of how you need to look at the average stats, the severity, and how these claims can lead across jurisdictions as well.
Yeah, so as rightly said, for cyber also we have seen that such kind of cases is coming just because the first party loss is what it is being covered under the Indian jurisdictions. So mostly that is being claimed by the insured. That's why the tail is 1 to 2 years. Had it been a case of the class action suit, as we have seen in other jurisdictions, this still would have gone much higher to 3 to 4 years.
I think another aspect also to keep in mind is the tail of class action suits also in a market like US has started to shorten. I think that is also a global phenomenon that we are seeing, where a lot of the classes get formed very quickly, get admitted quickly, and some get prolonged. So it really depends on the size of the class. So I think a lot of these complexities also add up to the average TAT of a claims closure.
So what we have observed, I mean, post-COVID period is that the claim under PI policy has been increased as compared to what we have seen in previous year. So after COVID, the claim under the PI policy that has been increased drastically. So intimation under those policy has increased. And apart from that, the inflow of other policies remain as it is, but this is one of the observations. So we want to highlight over here.
Post-COVID is one, but the other point is very critical, because you are seeing, so we're in a slightly deadly combination of two things. One is the cyber activity globally and particularly in the country is also quite rampant. I mean, either you are a victim of a cyber incident, or you're not aware that you're a victim yet. I think that is the scenario that we are operating under. So with the increase in cyber crimes, I mean, and cyber crimes impacting PI, so cyber induced PI is one is one very interesting claim scenario that is developing, but also because you have a general slowdown in the economy now. When that happens, then a lot of PI contracts get triggered because of non-payment of customers to, say, clients, claiming that there is deficiency of service, and they counter sue them. So that scenario, because of the economic slowdown, plus a cyber-induced PI scenario of a claim also going up, is putting generally the PI, particularly the tech PI segment, under a bit of caution and watchfulness. That's another trend that's developing.
So next one, let's quickly take up the case studies which we have for the group. Yeah. So the first one is arising out of the CFAIR policy. It is a commercial general liability. So it's a case where the insured was into an agreement for the supply of hydraulic cylinder to its customer. And there is an issue while they were manufacturing this hydraulic cylinder. So it is identified by their client that the welding of that cylinder is not properly done, which have resulted into some damages to their properties. And by having a root cause analysis, they are able to identify that there is an error of incorrect welding. It is not properly being done. So for that purpose, their client insured client has returned all those goods and they have claimed for the expenses which they have incurred due to this faulty products. So we have assessed the claim under the CJ policy. We found that this policy get covered. Sorry, this claim is get covered under product guarantee extension, and thereby the claim is payable under this policy. Coming to the next example on the CGL one. So it's a case wherein the our insured it is a organization who manufacture refrigerator. He had sold that refrigerator to the customer. Customer was using it, and one fine day that refrigerator caught fire. And in the fire brigade report, it is confirmed that the fire root cause of fire was the heating of that electric equipment. Due to which this fire was erupted. The survey has also confirmed the cause of loss and assessed the amount which is payable under the policy, which is directly associated to that loss. And we have covered this claim under CGL policy under the head of product completed operation hazard of liability coverage. So this is where it formed coverage. Next one, please. Next one on the CGL. So it's a very normal case which we are seeing nowadays that it's a slip and fall cases wherein the person checked into a hotel of our insured. While walking down, he fall and he had some injuries into his hand, and he has incurred some kind of expenses in order to address those injuries. And then he has claimed the compensation from the insured through legal notice, and the claim was intimated to insurance company under CGL policy. So since the policy has an endorsement of medical expenses coverage, so medical expense coverage was payable, and similarly the compensation for injury that is also calculated and that is being paid to that victim, and the matter was amicably solved. Yeah. Then this is a case of workman compensation policy. So basically, the insured is into a digital printing work. The employee that is being employed was working in the machines, and one fine day his hand got trapped into the machine, and this hand got amputated, and doctor has issued 40% disability, permanent disability to that person. So as per the WC Act, there is a specific calculation for all this compensation by applying the multiplier of age, income, and the disability. So as per this case found payable under workman compensation policy because it is arising out of the course of employment. That's right. Similarly,
so this is both the payment for the injury plus also the compensation as defined under the Workmen's Compensation Act.
Right. So similarly, the crime policy.
The earlier one, if you can.
Another previous slide.
Yes. Yeah. So in this case, the person was a mansion who is erecting a boundary wall for a project site. And around 4 p.m. in Indian timing, so there was a thunder and storm, due to which that the person sustained injuries, and he was shifted to the hospital for his treatment. And since this injury has arisen during the course of his employment, and the policy of workman compensation policy will trigger this policy will address this, and we found coverage under the policy, and we have paid this claim under the policy. Next one, please. I think the text is missed out. Rather,
Yeah.
can you get one? Can you move?
Right.
Yeah. So it's a matter of crime policy under employee theft coverage. One contractual employee of insured, he has manipulated the payroll system of the insured by activating 44 bank accounts which have been used for ex-employees, which was closed by that time, and those fund was siphoned to his own personal use, and resulting in a total loss of around 72 million to the insured. When the insured was aware of this fraud which has happened, he has intimated the claim to the insurance company and also filed the police complaint against that involved employee. Police has investigated the matter, arrested the person, and police has also recovered whatever fund they could have recovered from that person. And by assessing the police report, charge sheet, which is filed by the police and the internal investigation of the insured, we find that this case is covered under crime policy insuring clause 1, that is employee theft coverage, because there is a direct loss to the insured, which resulted into loss of money to the insured. And that's why it get covered. So key point over here is that there is amended definition of employee which cover the contractual employee also, any wrongful act done by the contractual employee. So
Yeah, I think that is very critical because unless you very specifically mention a contractual employee is covered, through the endorsement or the coverage position that was given under employee theft coverage, it then becomes a gray area where typically your contractual employees are not covered. But I think in this case, there was also a specific exclusion of defense cost, right? And any other cost that you would have to incur to recover the loss. So that is something which is very particular. But in a lot of cases, there is also a carve back, available for these costs to be covered under the policy.
Next step, please. So again, on the crime policy comes under employee theft coverage, wherein the person has the CFO has shared this banking credential to one of the employee, and that employee has misused the credential of CFO and thereafter transferred certain amount to his own bank account. Then they, on realizing this fraud, company has filed a complaint against that employee, and we have analyzed the case. We found that there is an exclusion which is applicable over it. That is a contributory negligence. That the insured has acted against the defined SOP of the company. That is, it is required that he should not share the password or the credential to anyone. But even though he has shared those credentials to their employee, which he is not supposed to do, and thereafter we have assessed the claims under employee theft coverage. Next one, please.
So maybe you want to explain a bit more on the previous slide, please, on how the contributory negligence will sort of define the quantum of claim payout.
So in this case, what has happened that there was a established case that yes, the SOP was breached. The CFO has intentionally given the ID password to that person in order to issue such kind of funds. But the involvement of CFO wasn't established. But it is you can say that it is a bona fide mistake by breaching the SOP. So in such cases, we have attributed certain amount of negligence to CFO to the organization. And in such cases, we have not paid the full amount, but allocation was applied in this case. If I'm not wrong, it is somewhere around 40-50% allocation which is applied in this case.
Yeah, I think that is a critical aspect in a lot of crime policies where you find even in established companies, while there is an SOP, then there is a deviation also from the SOP, and I think that is where when we also underwrite crime policies, but more so when we look at it from a claims perspective, it's very important for us to then assess what was the process, what is the setup from a tech perspective, and why there were deviations to the process and whether there should not have been a deviation to the process. So this is one classic example, and unfortunately, in a country where you have a lot of MSMEs and SMEs, growing, and then the pertinent risk of employee theft becomes quite high, and so will then the policy respond accordingly if you have a breach of warranty via contributory negligence.
Next one, please. So this is for the case study. So next one we have that is the important requirement while anyone register a claim under liability policy. So it comes with a disclaimer that any claim or circumstances should be timely intimated to the insurance company. And as all policy says that even before incurring any expenses, you should take the consent from the insurance company. Appointment of counsel should be properly consented by the insurance company, because for each matter, the different counsel will be required. Not one counsel will be okay for all type of matters. So for each set of dispute, you should take a consent from the insurance company. Then same thing applies for the settlement. If you are entering into any kind of settlement, take the consent from the insurance company before entering into a settlement. Next slide, please. So this is the the applicable PPHI guideline, which we called as protection of policyholder guideline, which is relevant for liability claims when we handle any kind of case. So the key point over here is that to assess any claim, if we appoint any kind of surveyor, then he should be properly licensed by IRDA to have that functions. As per recent guidelines, it is directed that at the time of claim, we are only required to call for claim-related document. We can't ask for, or the claim department can't start doing underwriting at the time of claim. So the requirement for a document should be claim-related only. Then there is another provision of 2% penal interest if the claim is not settled within 30 days from the receipt of survey report. So this is the penal action which is being provided by IRDA. If the insurance company doesn't pay the amount within 30 days of the receipt of survey report, then insurance company is liable for that. Then claim payment, yes, the payment can be made to the beneficiary or to the insured, which is mentioned in the policy schedule. Then, as an Indian insurer, we can make the payment to the in foreign exchange, in foreign currency, subject to RBI regulations. So there are certain conditions how we can make the foreign payment. That is, the policy should be in foreign currency. The insurable interest is established in the foreign entity or the property for which the loss is being claimed. The payee is insured under the insurance policy. So to whom we are making the payment, it should be beneficiary or as an insured under the policy. So these are the three main criteria basis which we can make the payment in foreign currency. Next one, please, Prada.
So I think with that, Ramraj and HDFC team, you are completing the presentation, right?
Yeah. So this is all for from HDFC Ergo on the claim side. Thanks everyone for hearing us out and taking the time for this workshop.
Fantastic.
Joe, over to you.
Yeah, perfect. Thanks, Anuradha. And I guess firstly, a big thanks to Anuradha, but also to the whole of the HDFC Ergo team for walking us through that presentation and providing such a detailed and comprehensive overview. It really is appreciated. Before we turn to questions, we just wanted to use the opportunity just to highlight and remind our customers and brokers some of the support that's available from the claims relationship management team, notably in the form of our claims handling protocols, which I guess we continue to see as a key tool, if you like, in our armory when we look at addressing some of the unique challenges that you can face in the context of international program claims, and really trying to provide you with some reassurance and some certainty, particularly in terms of communication, both from a local and global perspective. So if not in place already, I guess it's just to bang the drum, if you like, and offer that support. Please don't hesitate to reach out to myself or a member of the claims relationship management team, where we can make sure that you have a tailored and effective protocol in place. Separate to the protocol piece, you can see just a snapshot also of events, of topics, of webinars that we've run and delivered successfully this year. So I suppose another ask following today is just we'd really welcome your feedback. We're beginning to make plans for next year. So if there's topics or territories that you'd like us to cover, then please let us know, and we'd be really grateful for that feedback. I'm pleasantly surprised, maybe I shouldn't be, but I am pleasantly surprised that we're running sort of bang on time at the moment. So I think we've definitely got an opportunity just to pose some questions that have been submitted back to the HDFC Ergo team before we bring things to a close. So the first question that I've received to the HDFC Ergo team is in relation to the policy structure. It's probably an underwriting question. The question is, can local policies in India be issued in other currencies, or is that only possible in local currency?
So, Joe, we can issue policy in other currency also. So it is not restricted that we only issue policy in INR. So we are issuing policy in USD. So regulation also support on that line.
Yeah, you predefine the exchange rate in the contract for contract certainty, but yeah, you can issue policies with different currencies locally.
Yeah.
Okay, thank you. The next question is more of a claims one and is probably quite broad, but grateful for sort of your thoughts on this. Is there a key bit of advice you would offer to our customers to make the claims process more seamless, more efficient in India? What would be the key bit of advice you would give to our customers?
So as a key feature, as I have stated earlier, that as a claim process, it is always it is always asked to the insured to intimate the claim timely. This is one of the key factors. So whenever you receive any kind of circumstances which can lead to a claim, you should report to your insurance company immediately, because in liability we have seen that a claim can grow to any level. So it is just a peak of the things which can grow into any extent. So it is always advised to the insured, whenever a circumstances exist, please inform to the insurance company.
I think that's a very good practice that you highlight, and it really depends on how different companies also look at these circumstances. Some take a very I would say conservative approach of reporting everything that comes through their door as a circumstance reporting. Some do filter out a little bit to think about what could be the impact and then report it. But whatever the approach is, depending on how you want to view that circumstance, it's very critical that you report them immediately. Sometimes even the conservative approach works, I would say, where you never know how some of these claims can develop, very quickly. So being able to have that hygiene largely to report circumstances in a timely manner is the first step. I think one of the challenges that we've also seen is a lot of these, in a lot of cases, a contract very specifically says that when you have a defense counsel or a legal, firm being engaged, it needs to have the prior approval of the insurer. And when you make settlements, then that needs to be with the prior consent of the insurer. A lot of the times, these two very pertinent points, tend to get slightly overlooked, because of which we tend to, not be in a position to engage with the client, support them better, help streamline costs both on defense expense and the settlement amount. So that becomes, again, this example Ramraj mentioned in terms of contributory negligence. It also works here where when you don't typically, take our support or inform us and get the consent of the insurer, then it has an impact on the quantum of the claim that's paid. Yeah, and I think as a company, we, have a very good hygiene of regularly following up for data requests, and then timely submission of evidence would absolutely help us in providing, coverage positions and steering claims.
Fantastic. No, thank you for that. Just a follow up question, I suppose, to the original one around local policy currency. We've had a question submitted by one of our customers that's joined us today. Is it possible for local premium to be paid in different currency? And they give an example of GBP or US dollars.
We are receiving premium. There are sometimes the transaction, the premium is paid by the corporate clients. But you'll have to tell us, and accordingly we'll raise the invoice in dollars or whichever currency is required.
Okay. Perfect. Thank you. I'm just checking. I think that those are the main. I think we had a couple of people raise the same question around the currency points. So hopefully we've been able to address that. I guess just to remind, I mean, if there's any, we will share a copy of the recording and a copy of the slides also. So if there's any questions that any of our customers, brokers, partners think of after the event, then feel free to direct those through to myself, and we'll try and get an answer back to you as quickly as possible. But I think otherwise that brings us to the close of the webinar today. So just a big thank you once again to the HDFC Ergo team, to Anuradha, but also to all of you that have joined today. We really hope you found this session helpful. We hope you found it informative. And we hope you all enjoy good second halves of your week. We'll share the information following today, and hopefully look forward to seeing and speaking to some of you again soon.